TotalEnergies SE is one of the world's largest integrated energy companies, with operations spanning oil, natural gas, LNG, refining, marketing, renewables, and electricity. The 2026-2027 investment case is particularly interesting because TotalEnergies is not simply an oil producer. Its integrated model combines upstream oil and gas, LNG, downstream operations, and a growing integrated power business. Management's long-term strategy targets approximately 4% annual growth in total energy production through 2030 while maintaining disciplined capital spending and shareholder distributions. At around $89 per share in late August 2026, TTE is trading at a valuation that still reflects the cyclicality of the energy sector rather than a premium growth multiple. Recent second quarter 2026 results showed strong fundamentals, with TotalEnergies generating $9.8 billion of cash flow from operations excluding working capital and $6.0 billion of adjusted net income. Gearing also declined to approximately 13%, while the company increased its interim dividend by 5.9% to €0.90 per share. TotalEnergies entered 2026 from a relatively strong financial position. In 2025, adjusted net income was approximately $15.6 billion, down 15% year over year because of lower oil prices, while cash flow from operations remained close to $28 billion. Importantly, production grew approximately 4%, showing that the company could expand volumes even in a weaker commodity price environment. TotalEnergies also reported a 12.6% return on average capital employed for 2025, highlighting the profitability of its integrated business model. The first half of 2026 has been considerably stronger. TotalEnergies generated $18.4 billion of CFFO during the first half, up 35% from the prior year period, while adjusted net income reached approximately $11.4 billion, up 47%. Second quarter adjusted EPS was $2.68, and the company finished June with gearing of only 13.1%, compared with 17.9% 1 year earlier. This combination of earnings growth, cash generation, and lower leverage provides an important cushion if commodity prices weaken later in the cycle. For my 2026-2027 base case model, I estimate TotalEnergies revenue of roughly $235 billion to $245 billion in 2026, followed by approximately $225 billion to $240 billion in 2027. These figures should not be viewed as a straight-line growth forecast because energy revenue is heavily influenced by oil, gas, and refining prices. My fundamental assumption is that production growth and LNG volumes offset some commodity price normalization. The company expects more than 3% annual oil and gas production growth during 2025 and 2026, supported by new projects in Brazil, the United States, Iraq, Uganda, Qatar, and Malaysia. For adjusted EPS, my base case estimate is approximately $9.50 to $10.50 for 2026, followed by $9.25 to $10.25 in 2027. The range reflects commodity price uncertainty. The first half of 2026 already produced $5.14 of adjusted fully diluted EPS, up 51% year over year. If oil and LNG prices remain supportive, full-year EPS could finish toward the upper end of this range. If prices normalize substantially, earnings could move toward the lower end. One of TotalEnergies' strongest advantages is its project pipeline. Management expects oil and gas production growth of around 3% annually through 2030, with growth above 3% in 2025 and 2026. New production from projects including Mero 4 and Lapa Southwest in Brazil, Ballymore in the United States, Mabruk in Libya, Northfield expansion in Qatar, and Jiran in Malaysia should provide incremental volumes. Second quarter 2026 hydrocarbon production reached approximately 2.395 million barrels of oil equivalent per day, with organic growth exceeding 4% year over year. LNG is one of the most important parts of the 2026-2027 thesis. TotalEnergies expects LNG sales of more than 44 million tons in 2026, while new projects should increase volumes and help offset weaker LNG pricing. The company also expects integrated LNG cash flow to grow more than 70% between 2024 and 2030 under its strategic assumptions. This gives TotalEnergies exposure to global gas markets while reducing dependence on pure crude oil production. The second major growth pillar is integrated power. TotalEnergies plans to increase electricity production by around 25% in 2026 to more than 60 TWh, supported partly by the EPH transaction and additional flexible gas power capacity. In 2025, the company already had 48.1 TWh of net power production and approximately 34.1 gigawatts of installed renewable generation capacity. The strategy is therefore gradually transforming TotalEnergies from a traditional oil and gas major into a more diversified energy company with significant electricity exposure. Capital discipline is another major positive. TotalEnergies expects 2026 net investment of around $15 billion, while its longer-term strategy targets approximately $15 billion to $17 billion annually during 2027 to 2030. The company has also announced a $7.5 billion savings program covering 2026 to 2030. Around $4 billion per year is expected to be allocated to low-carbon activities, including approximately $3 billion to $4 billion for integrated power. Free cash flow is arguably more important than revenue for the TTE investment case. The company's first half 2026 CFFO of $18.4 billion is already significantly above the prior year level, and management subsequently raised its 2026 cash flow outlook to approximately $34.5 billion to $35 billion. The balance sheet is one of the strongest parts of the story. Gearing fell to approximately 13.1% at the end of June 2026, compared with 17.9% 1 year earlier, after TotalEnergies reduced net debt by approximately $3.3 billion during the second quarter. The company targets maintaining gearing below 20%, giving management considerable flexibility to fund projects, pay dividends, and repurchase shares throughout different parts of the commodity cycle. The dividend is a major reason investors may consider TTE. TotalEnergies increased its 2026 second interim dividend to €0.90 per share, representing a 5.9% increase from the comparable 2025 payment. Management continues to emphasize dividend growth and targets shareholder distributions of more than 40% of annual cash flow through the cycle. The company's strong balance sheet makes the dividend considerably more resilient than it would be for a highly leveraged producer. Buybacks provide another layer of shareholder return. TotalEnergies repurchased approximately 16.9 million shares for $1.5 billion during the second quarter, bringing first-half repurchases to about $2.25 billion. The board also authorized up to another $1.5 billion of buybacks for the third quarter. Buybacks are particularly valuable when the stock trades below intrinsic value, because they reduce the share count and increase each remaining shareholder's proportional ownership. Using a normalized long-term free cash flow framework, I estimate TotalEnergies' intrinsic value at approximately $100 to $105 per share in my base case. My model assumes normalized free cash flow around the high $20 billion to low $30 billion range, moderate long-term growth, disciplined capital expenditure, and a discount rate around 9%. Because TTE is a cyclical energy company, I would avoid an aggressive terminal growth assumption. The goal is to value the business through a normalized commodity cycle rather than capitalize one exceptionally strong oil price year. A second valuation approach gives a similar conclusion. If TotalEnergies produces approximately $9.50 to $10.50 of normalized adjusted EPS and receives a roughly 10.5x to 11.5x earnings multiple, the resulting valuation range is approximately $100 to $120 per share. A higher multiple would require investors to believe that LNG integrated power and production growth have structurally reduced the company's historical commodity cyclicality. In my bull case, Brent crude remains structurally strong, LNG prices remain healthy, refining margins normalize at attractive levels, and TotalEnergies successfully executes its production pipeline. Under that scenario, adjusted EPS could move above $11. Free cash flow could remain very strong, and the market could assign a 12x to 13x earnings multiple. That produces a 2027 bull case price target of approximately $130 to $140. My base case assumes normalization of oil and gas prices rather than a collapse, continued 3% or better production growth, healthy LNG volumes, disciplined capital spending, and continued dividend growth. Under these assumptions, I estimate fair value around $105 to $115 per share. In the bear case, Brent falls materially, LNG prices decline, refining margins weaken, and geopolitical disruptions reduce production. Earnings and cash flow could fall significantly, while the market could compress TTE toward an 8.5x to 9.5x normalized earnings multiple. Under that scenario, I estimate a 2027 bear case price target of approximately $70 to $78. Putting the scenarios together, my 2027 price targets are $75 for the bear case, $110 for the base case, and $135 for the bull case. With TTE recently around $89, the base case represents approximately 24% upside before dividends, while the bull case represents roughly 50% upside. These are my model-based estimates, not company guidance. The biggest catalysts for 2026-2027 are continued oil and gas production growth, higher LNG volumes, successful execution of new upstream projects, stronger integrated power cash generation, further debt reduction, and continued dividend increases. Another potential catalyst is the market increasingly valuing TotalEnergies as a diversified energy company rather than simply applying a traditional oil major multiple. The largest risk remains commodity price volatility. A major decline in crude or natural gas prices would directly pressure upstream cash flow. Geopolitical risks are also significant because TotalEnergies operates across numerous regions. Additional risks include refining margin weakness, project execution problems, currency movements, regulatory changes, and the possibility that renewable energy investments generate lower returns than expected. The strongest argument for TTE is the combination of production growth, LNG exposure, power diversification, low leverage, and shareholder returns. Management is simultaneously growing volumes and controlling capital expenditure. If commodity prices remain reasonably supportive, TotalEnergies could generate substantial cash while continuing to reduce debt, repurchase shares, and increase dividends. The biggest reason to remain cautious is that investors are still buying an energy company. Even with LNG and electricity diversification, oil and gas remain critical to earnings and cash flow. A prolonged commodity downturn could reduce earnings, free cash flow, and buybacks. Geopolitical events can also create unexpected production losses and unusually high commodity prices, making short-term earnings difficult to forecast. Based on my 2026-2027 framework, I would give TotalEnergies approximately 8 out of 10 for balance sheet strength, 8.5 out of 10 for cash generation, 8 out of 10 for shareholder returns, 8 out of 10 for project growth, and 7 out of 10 for valuation. The weaker valuation score is not because the company is expensive, but because the energy sector remains highly dependent on commodity prices. My final rating for TotalEnergies is BUY, but with a value-oriented approach. At around $89, I believe the risk-reward is attractive enough for a long-term investor because the company combines strong cash generation, low leverage, growing production, LNG exposure, electricity expansion, and an attractive dividend. However, I would not treat TTE as a high-growth technology stock. The investment thesis depends on buying a high-quality energy business at a reasonable valuation and allowing dividends, buybacks, and cash flow growth to compound over time. To summarize, my 2027 bear case is $75, base case is $110, and bull case is $135. My DCF-based fair value range is approximately $100 to $105, while an earnings-based valuation suggests roughly $100 to $120. Therefore, I see $105 to $115 as a reasonable central valuation zone, with substantial upside possible if commodity prices and LNG markets remain strong.